Hello and welcome. You're watching Closing Trades here on ET Now. I'm Harsh Saita. Let's quickly look at what markets are up to, and we're just going to have a quick, sharp conversation with Samir Arora on this day, 1st January 2026. Great day to have that conversation, set the context for the rest of the year. But very quickly, firstly, on to the Nifty. Absolutely flat as we speak. We've given up some of the gains that we had clocked in today morning. In fact, some of the gain, it's fairly range bound as well in terms of the markets. Just 80-point band that we're trading in. So that's the other piece that's playing out today. In terms of the key losers, ITC is the big loser today. 9% lower on ITC, DRL, Bajaj Finance seeing some bit of a pullback. In terms of the gainers, there's Eternal, which is standing out. NTPC, Wipro, Bajaj Auto are just some of the names, and auto counters would likely continue to remain in focus as the day goes by. And in fact, even tomorrow, because of those auto sales numbers which are continuously trickling through. IT is the index which is standing out in terms of the sectoral indices. And even within sectors, there's plenty of movement. IT is up around 0.9%. Auto is also up around 0.9%. 0.7% higher for the Nifty Realty Index, which is sharply underperformed last year. 3% lower on FMCG, largely driven by ITC and Godfrey Phillips. Those are the two big counters which are lower. Defense is down around 0.7% thereabouts, so some pressure there. And along with it, Pharma too is down. But let's bring in Samir Arora, founder Helios Capital, to give us that perspective. Samir, great having you. First off, this is Harsh here. Samir, let me first set the context for 2026. Is it going to continue to be the kind of market we've seen over the last couple of years, where certain sectors which have underperformed may come back to the fore, or is it going to be something materially different? What can one expect?
Well, first thing is that 2 years have been quite different in the sense that 24 was a very strong year, nearly across markets. And 25 may have had this tendency where, say, auto did very well and IT did very badly. I would think it would be broader than that. And even if the market goes up a lot, the relative underperformer of IT, I think, will still stay. Auto, I'm not sure. But in general, the market would be, you'll feel happier in this year, I think, than we did in 25. Although at the end of the year, the overall numbers were some 5, 7, 8% up for the various benchmarks, which were not bad after 2 years of very strong performance, but looked bad because the rest of the world was having a bigger party than we were having.
Absolutely. And Samir, the real pain is being felt at the broader end, right? Certain individual stocks, and especially those within broader markets, have especially seen pain. Portfolios don't seem to reflect what the Nifty has done this year. Do you believe that will change materially as earnings starts to pick up as well in 2026 calendar year?
No, because that is what portfolio means. Portfolio means that you cannot have only in some stocks that you have, seen on YouTube an interview for 10 minutes and suddenly felt strongly about the management or something. A portfolio is designed so that some stocks may do badly and some will do well. And it is very difficult for anybody, including the biggest fund manager of the world, or the best fund managers, to have it right every year. So it will not be, because some other stocks will do very badly. We show all the time on our website that nearly every year, not nearly, every year, broadly 30% of the index stocks underperform the index itself by more than 25, 30%. So, and then there's another side, which is some 30% stocks from the index beat the index by 20% per annum. I mean, not per annum, in that year. And so that will happen sometimes. So you have to sometimes see that which are the losers of, say, 25, and maybe some of them will go to the other extreme other side, but then something else would go into the bottom 20. So this difference every year, if you see between the best and the worst, I saw, I think yesterday only somebody had put out on Nifty, like Shriram is up some 70%, and their stocks down 20% from the same index. This happens all the time, every year, year after year.
Point taken. Samir, what seems to be likely this year at least is an earnings cycle uptick, which didn't play out in 2025 at all, or just has played out in maybe Q2 for a little bit. How significant is that going to be? In your opinion, can it surprise on the upside to what the consensus currently pencils in?
Well, I don't know what the consensus is, but in absolute, the numbers don't look bad. For example, I saw recently, I think HSBC or somebody had 17% growth for the stocks under their coverage. See, broadly anyway, the normal earnings growth this year, even in a bad year, might be 10, 11%. And now with the fact that there was this consumer push and very significant interest rate cuts, and in general, a little bit of a cyclical recovery after 1 or 2 years of very big slowdown in consumer sector and even in some parts of infra, that to go back to 13, 14 would have been anyway expected. But if you get some of these elements right in terms of the rest of the world still doing okay and we getting some break on our India US tariff, then 16, 17%, which is higher than longer term average, is being expected by a few. I don't look for it like that, because my logic is that if the market is expected or the earnings are expected to be above 12, 13, 14%, it is anyway better than anything else you can do with the money. So if you tell me that the earnings growth will be 17 versus 14, my asset allocation, my bullishness on equities won't change. If you say it'll be 25%, maybe I'll have to sell some other things and buy equity. But broadly within this range, any number is acceptable because it'll be better than whatever alternative use you can have of your savings.
Right. Uh, uh, one of the possible risks to 2026 could be a US slowdown. We've spoken about this in the past. It's not come through, Samir. You expect 2026 to be that year where the US slows down, and this is despite the fact that there's one rate cut still expected, and there could be a downside risk or an upside risk, if I can call it that, to more rate cuts happening as well. So trying to get your sense,
So we
US, if
didn't
the biggest
benefit.
consumer slows down, is that a risk?
Well, not for us, sorry to say, because they don't allow us to export there. So how do we care for their consumer if we can't send our stuff there? So this is a relative game if that happens. If of course the US slows down a lot, which leads to a crisis kind of a situation for global growth, this, that, then everybody gets affected, even if they have no real direct relationship. For example, in 2008, Indian banks, Indian finance companies did not have any exposure to subprime crisis and to all those CDS and whatever else used to happen. But the Indian stocks fell as much or more. But if it is a slowdown where when it was growing well, we were not participating through our exports or otherwise. And so if it slows down, doesn't matter to us beyond a point. We could be big relative outperformers. And relative outperformance is a useful start, because the world has to say that, okay, you can't keep ignoring India forever. They have not been ignoring forever, but I'm saying in recent quarters they have. Therefore, I feel happy that from October 1 or from September 30th, that means the current quarter that just ended, the last quarter, India market actually did better than most other markets. It did better than US market. It did better than emerging markets in aggregate. It did better than China. The point being that the trend seems to have changed, that we are no longer underperforming. We are not catching up with whatever previous 9 months of underperformance we had as a market. But relatively speaking, if there's a US slowdown, there might be many other countries which may worry. India has less to worry because we are not able to participate in whatever growth they are having anyway.
Uh, there has been plenty of chatter around a possible inflection point where IT is concerned. You believe some point in 2026, IT will reach that inflection point, especially when it comes to growth, which has disappointed, or rather has largely been very low single digit, been in line with estimates, but still, from an investor standpoint, has disappointed?
The thing is, they have to tell us that they are growing. Why should I keep here thinking it's a point is coming? The only logic being given is that Indian mutual funds have too much money, and to try and outperform each other, they are only looking at what the other guys don't have. So let me buy that and then start praying immediately There is no other logic given if you see in all the discussions that you have and others have, except that it is under-owned and it has underperformed. Well, there are hundreds of stocks that suddenly, because for example, these days, why don't we talk about levers growth? Because it used to have its growth in those days and now it's one more regular company. So like that, it can easily happen with many subsectors, sectors, parts of the economy. We think that it is a very regular, small, 6, 8, 9% type growth. We are not currently interested in that unless you tell us that the earnings growth of the market will be 5%. Why should we, where our GDP growth in nominal terms is maybe these days only 10, but normally 12, 13%, we should be worrying about whether there'll be a turn because nobody's clarifying exactly what the longer term impact is. And also, one more thing, please note that in India, the growth is happening. If the number of employees in these uh, GCCs is, say, around 20% of the overall IT employees, and let us say, I don't know, let's say it has all happened in the last 6, 7 years, then broadly the GCCs have taken away 3, 4% growth from the IT industry per annum. So there has been growth. People are investing, people are doing, except that they are doing it on their own. Now, we don't look at anything like that. We talk about, oh, these stocks have reached longer term average multiples. Why should something be always trading at average multiple? That means there were some periods when they were trading below that average. So, what was the situation then? What was the growth outlook then? This period looks to me like a below average earning multiple environment rather than, oh, it's reached average. Why should either a stock be over the average, higher than average, or at average? There are many things which are below average. That is how the average itself came up. So we are currently not interested, but it doesn't take us long because we don't take 6 months to change our views. If they change, if something changes, if guidance changes, if hiring changes, we can change. What is the big deal? But right now, no interest.
Flows, Samir, how much of that component will likely play out in 2026? Do you believe FI flows will come back in a solid fashion?
So solid fashion means actually, if you look at it, last year was not very bad if you started from Feb 1 instead of Jan 1. So for the whole year, I think, I don't know now recent last few days numbers, but broadly till a few days ago, India had $17 billion of outflows. And in that, January itself was 10 billion. So from Feb 1 to December 31st or whatever, December some date, it was only a $7 billion outflow. And during that time, A, we had a war with Pakistan. And B, we had a war with US on tariffs. And after all that, and we don't have AI related stocks. And we had done, as the market had done very well in 23 and 24. And China had not done well. And Korea had not done well. And so, therefore, if 7 billion, let's say, I'm deliberately not calling it 17, now you can say, oh, I have selected it. But these are not separate months collected. It's a continuous 11-month period that I'm saying. That if some of those things change, the natural tendency of foreign investors is to buy. Now, these days, they used to buy through private equity. Sometimes they buy through public. In aggregate, they buy. Now, what happens is that because some of the private equity deals did well, investments did well, they sold. Now, that is part and parcel of the PE world, in which also, by the way, some part of it has been bought via an FI account. So it comes under an FI heading also. Basically, it was a PE investment. Maybe the last round guy, the crossover funds, the pre-IPO guys, they all buy. They are mostly FIIs rather than Ps. But when they are selling, it gets classified as FII. Broad picture is that if they are investing in every other country in the world, broadly this year, what is the logic, even one line logic, that they would not buy India? So then people come up with this theory because everything is done to justify this thing, is that they find India expensive. So if they find India expensive, you see the only things they sell is financial stocks, consumer stocks, IT stocks, which are broadly not as expensive as the stocks they buy, which are all these new age companies which get oversubscribed 100 times, mostly by foreign investors. And so it's not valuation. It is just that these things happen every now and then in markets, that one market has two, three factors combined, and therefore people do other things and then they remember. But it's not that anybody is walking away from India. For Helios Capital, just tell you one line, our FII AUM has more than doubled this year.
Yes, I'm aware of that, Samir. So therefore, if they do come in, do they again go back to their go-to sectors, financials and IT? Are those the
So
pockets
I
which
would
they go
think,
to?
so I would think first, if they stop selling, that is a highlight of
Sure,
life. Then rest the
I
mutual
beg your
fund
pardon.
guys can handle. And secondly, I would think that they will first buy financials. For example, if you think that they were heavily invested in IT, they invested in Korea, Taiwan, they invested in all these places because India did not have IT. Then when they suddenly become bullish on India, they buy Indian IT as their first stop is to me less likely. But I'm saying even if they stop selling, all these things will do well, including Indian IT. It's just that these are relative choices that we are making between in our portfolio of $100 that how much has to go here or there. But broadly, if they stop selling, that would be a big starting point, which I think is happening or more or less has happened plus minus. Because if you see from October 1 to today, I think FI flows may not even be negative. Or if they're negative, it'll be less than 500 million. Because October itself was very positive and November half was quite positive. So you may have lost that whole thing again. But broadly, you have come around near like zero type number on a net selling basis. I think financials is easy because the growth is still there and the interest rate cuts have helped the NBFCs and all. You can see all the performance of Chola and Shriram and Bajaj Finance and all that. And some of that will happen in the banks, hopefully now.
Worried, Samir, with the fact that the DI flows are so strong, and if the FI sell number starts to come off or to taper, which is what the hope is, just the DI flow number continues to remain that strong. What are the options for DIs to really invest in? Are you worried about that?
No, no, I'm not worried. First, let me get some gains before I worry about what I will do with the. How can you worry about strong market? We worry about weak markets. Strong markets we enjoy. We don't worry. Okay, and this idea that oh market is strong is bad for investors, it's not like that. This is a continuum. So for example, I saw on Twitter yesterday one guy saying, oh, from December 1 people are looking at the market, they should look at it from September 24. Why? Because from September 24 it's down. Why not look at it from March 25 when it is up? This is a continuum thing. So people who will be rewarded if the market is good will give money, and then slowly they will again not do well for 6 months because the market would have gone up a lot, and then again. So it's a start and stop kind of thing. It's not a FD kind of a system that every day the market has to go up. But there is 1.5 years of relative underperformance and even absolute underperformance. I mean, it's only 5-6%. And therefore, if you see today, I read that one of the bigger fund managers of India who was warning against small cap stocks is now saying that small cap stocks are very good to buy or something like that. So all these things happen, and main thing is to lead, because nobody's investing at one point, nobody's exiting at one point. You have to look at it as a continuous this thing. We need a rally. We'll worry well into the rally, not today, please.
Samir, where railway stocks, defense counters are concerned, these are decadal themes, but at the same time, execution challenges remain in some of these pockets. How do you view that?
Broadly, we don't like decadal themes because that means for decades they have not worked. And we don't see much that suddenly something is happening. Broadly, defense as a theme is more little bit reasonable because it is in government's control to say that do not import but buy from local because they themselves are the buyer, and they can put blacklist and this list and whatever and encourage localization. That is imaginable up to a point. But I don't like these big investment themes which says that 15 years you're developing some fighter jets and 20 years you're developing a submarine. And so even if you get those big orders, we don't relate to them because we don't know for 3 years. If you go, they'll say we are still designing, then we are taking approval. So it might happen in 20 years because it was a 20-year order to begin with or 10-year order. From a stock market point of view, we are more interested in day to day. Day to day means year to year at least, or visibility year to year. And one more thing, if you see railways, they had this small hike of fare. Such a small hike, how that can change the investment thesis. Plus, you are doing it well before budget, which means in the budget you don't want to have even that hike. So I don't know. We don't have those stocks. Actually, we have one different stock because it's a, as we say, year-to-year stock, which is Bharat Electronics. You get small electronics orders, whether you're here, there, everywhere. You're not tied to any one big program, which is 15-year program. We don't like 15-year programs for investing. India needs, companies need, government needs beyond our imagination.
And last piece, I know you're playing consumption through some of the platform companies. What are the other ways to play consumption? And tell us how you think of it. Would you like a consumption theme to actually clock a 20% growth? Is that something that you look for? What are the filters you're using?
No. So what we say is that for new age companies with new age multiples, which have gone IPO, you better grow not 20 would be also too less, I would think, because these companies are loss making, near about break even. But just before that, there's been discussion on new age companies, particularly these food delivery, quick commerce companies, how they are exploiting everybody. Or just look at it. In a normal order of say 500 rupees, the delivery guy gets say 40 rupees. The dream, absolute dream of all these quick commerce companies is that one day we'll make 5% margin on the sale, which means we'll make 20, 25 rupees. So in a 60, 65 rupee thing that the rider plus the company will make, 2/3 is going to the rider. And the company is left with 20 rupees. And if they make 20 rupees, their stocks will multiple because of the scale. But from each delivery, you're making 10 rupees, 5 rupees today, so you're making zero. But let us say one day you make EBITDA level 20 rupees. So 2/3 is being given to the rider. Please give me one example, one company, one sector where the share between labor and capital is 60, 65%. Even in textile, it will not happen. In IT, it does not happen. In no other sector, it happens. So this is a great sector from India's point of view, also from workers' point of view, also because of the value add, 65% is being given to the worker. You can call him or rider or whatever partner. But anyway, I think it is the number one best way to play consumption because you are not relying only on the growth of the end consumer. End consumer growth will only be 6, 8%, 9%. How much will it be? You are growing because the consumer has chosen to buy her things from this channel versus that channel. And that growth, that penetration is very, very low. It can go up 100% per annum for 5 years and still it will not be a meaningful amount. So the idea that play the end consumer growth, because the end consumer does not grow as we have seen in the case of ACs and levers and all these consumer, because the end consumer growth will be 8, 9, 10%. How much more will it be? So we like these new age companies where the growth is coming because the consumer has chosen a different channel. For example, insurance growth is X. But if you're buying insurance online, everybody wants to buy online. Therefore, that growth is very high. The cash usage is very less, but now people use phone pay and Paytm and all this, so therefore their growth is higher. But that does not mean that we are expecting that the end growth of cash usage or payments or whatever has gone up. That is why we like all of these where it's a consumer play, but only on the how the consumer has chosen to use these new age these things versus the old.
You've been invested in financials for a while now. Why do you think that some of the larger cap financials lenders haven't really moved? What's the reason for that,
Well,
and what's the trigger going to be?
so one reason could be that you are looking at some wrong numbers. For example, if you say large lenders have not moved, so Bajaj Finance is up, I think some 40% or something like that. Chola is up some 40, Shriram is up 70. So I think you're talking about the banks. Is that the one? Because HDFC Bank also was not bad in 25, up 12%, and ICICI is up only 4. And I think ICICI, maybe they are worried about the management, that whether Mr. Bakshi will stay or not. I hope he stays or he renews. But generally, because of the low, the interest rate cuts hit the banks more than they hit obviously the NBFCs. But actually, the financials were one of the stronger this thing in 25. They've all
Point,
moved a
Samir.
lot.
I was talking about the
Yeah.
larger banks. Wish to
Correct.
rephrase
So
that.
banks, I think,
So,
yeah, basically, even here, State Bank did very well, up some 24%. I
yes,
think Axis also did well. So
yes.
broadly, they did well. It's just that ICICI, I think, got stalled or has got stalled because of that. And we are praying that Mr. Bakshi accepts a new term.
Sure. Last piece, how do you play auto? Do you play through CV, where the cycle is likely turning? Do you play through PV, two-wheeler? How?
So right now, we are not playing through all that. We are playing through auto ancillaries. And we were fortunate in being anchors in Ether, where we've added a lot later. But broadly, now we don't have the main big, although they are not bad, I would think, but we don't have, and we don't think we will have.
Okay. Samir, it's been a great conversation, and we've covered a large part of the universe. So thank you so much for coming in and speaking with us. This has been very, very enriching on this New Year day, and wishing you and your team a very, very happy New Year.
Happy New Year, guys. Bye.
Okay, and viewers, with that, we'll take a bit of a breather, slip into a very short break. On the other side, we'll continue talking stocks. Stay with us here on ET Now.